Ever felt stuck trying to trade when a trend suddenly dies? Most traders get caught off guard when a strong trend shifts into a range, draining their profit. You might think the market's unpredictable during these times. But here's the truth. Market ranges are some of the most predictable phases, and they hold the key to huge opportunities, if you know what to look for. Stick around, because what I'm about to share could turn those frustrating ranges into your most profitable setups yet. After a strong trend ends, many traders feel like they've lost the map. You're used to seeing clear upward or downward momentum. But now, the market is just going sideways. It's tempting to jump back in and try to force a trade, but that's exactly how most people lose money. Instead, I want you to think of market ranges as the market's way of catching its breath.
It broke out and continued higher. So you can see that what happened is that when the market made a large retracement move against the underlying trend or market structure, you should expect that, whatever has happened, whatever type of trend that has, existed earlier, probably is coming to an end and the market would move into a range. Okay, so this is what happened. So here's another example. Okay, so let me just share with you, what else? Palladium. Okay, let's see. So same thing for Palladium, right? Notice that again, over here, this market here, pretty nice, healthy trend, right? Trending move, retracement, trending, then boom! Over here, this candle, this retracement move, it's larger than usual. It does not behave like a normal retracement candle. And that should signal to you a sign, right? That this earlier trend, right? The easy money of, buying the dips, probably it's over, right? The market is likely to go into a range and then break out of it later on.
When a trend slows down, it doesn't mean the game is over. It just means the market is consolidating energy for its next big move. Imagine a sprinter who has just run 200 meters at full speed. They're not going to keep running at that pace forever. They'll slow down, catch their breath, and then either sprint in the same direction or turn around and go the other way. That's exactly what markets do in ranges. Your job is to figure out what's coming next and profit from it. So, how do you recognize when a trend is shifting into a range? The first sign is the shrinking size of candles. During a strong trend, the candlesticks are large and show decisive movement in one direction. But as the trend weakens, the candles get smaller, showing that buyers and sellers are struggling for control. At the same time, you'll notice the price starts to bounce between a clear zone of support and resistance. Let's say a stock has been trending upward, hitting $100, $110, and $120 in a steady climb. Suddenly, instead of continuing to $130, it starts oscillating between $115 and $120. That's a clear sign the trend has paused and the market has entered a range. Volume is another clue. During a trend, volume tends to be high as traders jump on board. Now, let's talk about what's happening behind the scenes. Market ranges aren't just random movements. They're a battleground. On one side, you've got buyers trying to push the price higher, and on the other, you've got sellers trying to push it lower. This tug of war creates predictable patterns. Price bounces between support and resistance. Take Bitcoin, for example. During its bull runs, there are often periods where the price stops climbing and moves sideways. Let's say Bitcoin has been trending upward and hits $60,000. It then starts bouncing between $58,000 and $62,000. What's happening? Buyers and sellers are fighting for control, and that creates the range. The good news is, this battle gives you clear levels to trade. So, how do you profit from ranges? You've got two main strategies: playing the range or waiting for the breakout. The first strategy, playing the range, involves buying near support and selling near resistance. For example, if the price is bouncing between $50 and $55, you'd look to buy at $51 and sell at $54. You need to wait for confirmation that the price is actually reversing off support or resistance. One way to do this is by using candlestick patterns like hammer candles near support or shooting stars near resistance. These patterns show that the price is likely to bounce. Suppose you're trading the EUR-USD currency pair, and you notice it's stuck in a range between 1,1000 and 110.50. The price hits 1,1000 and forms a hammer candle, showing rejection of the lower level. That's your cue to go long. Set your stop loss just below the support level. By trading this bounce, you've minimized risk while maximizing potential reward.
right? So you will have to change your strategy, right? You should expect the market will go into a range and then followed by a breakout of the range. So in this case, the market went into a somewhat of a range, descending triangle kind of pattern. Then it broke down, then form another range, right? And then form another range over here. Okay, so you get my point. So moving on, right? Once you understand this concept of the retracement move, okay, and the alert of the large range retracement move, let's move on and talk about the break of structure. So all these concepts are important because we later on will be using these concepts, right, to identify, healthy trend to trade and how to actually, predict, right, when the market is about to make a reversal. So all these concepts will come together and make sense to you later on. Okay, but I want you to pay attention to the break of structure right now. So a break of structure, it's quite straightforward. So in an uptrend, right, consists of series of.
The second strategy is waiting for the breakout. This is where the big moves happen. After a range, the price will eventually break out, either continuing the previous trend. But here's the key: you don't want to guess which way the breakout will go. Let the market prove itself. A strong breakout candle with high volume is your confirmation. Imagine crude oil has been stuck between $70 and $75. Suddenly, it breaks above $75 with a long bullish candle and a surge in volume. That's your signal to go long. Place your stop loss just below the breakout level at around $74 to protect yourself in case it's a false breakout. If the trend continues, you're positioned to ride the momentum. Breakouts can also go in the opposite direction. If crude oil breaks below $70 with a strong bearish candle, that's your signal to short. The beauty of this strategy is that it works in both directions. Now, let's address the elephant in the room: false breakouts. They're common in ranges and can trick even experienced traders. A false breakout happens when the price briefly moves beyond support or resistance, but quickly reverses back into the range. To avoid getting caught, always wait for confirmation. For example, after a breakout, look for a retest of the broken level. If the price holds above the breakout level, it's likely legitimate. If it falls back into the range, it's a trap. Finally, one of the most overlooked aspects of trading ranges is aligning your trades with higher time frames. Let's say you're trading a 1-hour chart and notice a range. Zoom out to the daily chart. If that range aligns with a significant support or resistance level on the higher time frame, the odds of a successful breakout increase dramatically. This alignment adds a layer of confidence to your trade. To sum it up, when a trend ends, don't panic. Look for the telltale signs of a range: shrinking candles, declining volume, and clear support and resistance levels. Use the tug-of-war between buyers and sellers to your advantage by playing the range or waiting for the breakout. Always manage your risk with stop losses. If you found this breakdown helpful, make sure to hit that like button and subscribe for more actionable trading strategies. And if you're ready to take your trading to the next level, check out the free resources linked below. Remember, trading isn't about predicting the market, it's about understanding it. Good luck and happy trading.